All right, Evan, we're back for another trading Q&A. What questions can we go over today?
Yeah, so we got two questions in some different topics, I guess. The first one is actually like a longer term question. I noticed that Jay mentioned in the Alpha chat, he's looking for a longer term play in ZM, Zoom video. It feels like remote work isn't going away, forming a base at lows and strong future guidance. So wanted to get your opinion on this one, if you think this is a good area to start buying long term, or what do you think?
All right, so give me 1 second. I'm going to share my screen. Okay, so we have Zoom up, we have Zoom video. The only again, for all the pandemic related stocks and the Zooms, the Pelotons, the Carnival Cruises, all those names, in my opinion, like I try to stay away from at any possible way. That's just my own personal thing. So like I personally would never buy Zoom. Again, we use it all day long. We're using Zoom right now, and we definitely use that service. We don't pay for Zoom, so there's not much. Obviously there's schools and everything that are using it, but the bigger thing is that like the percentage move that this name has had already. This is what was this 1,000% move, and it's retraced the entire 1,000% move. And that's the part where when people start to see this, it's like, well, I want to make 1,000% again. And I want to buy it here at 100, and I want to sell it back at 600. But the hard part is that like this was like, I don't want to say it's a black swan event, but this was just super hyped up during the pandemic, and it's going to get that same attention going forward, because now it's going to be more of the fundamental story that really no one cares about. And it's just people care about the hype. When Zoom is being mentioned on CNBC and MSNBC 9 or 10 times at any stock, just like it was with GameStop, that's when it gets those run-ups. But it's hard to keep that same momentum of everyone like, oh my God, I need to buy Zoom. It's going to go to 1 million because it's going to be the future. When now it just becomes a service people use, and it might have great fundamentals, but that's like a red flag thing when it's like, it had that dramatic run-up. It's basically fully retraced it. And that's the thought of, I want to get back in this second time for it to go back to here. And maybe it does, but I'd be a little skeptical. And if it does, it may take 5 or 6 years for that to happen. And realistically, most come back in over 5 or 6 years. So unless and I think even for the more of our guys with the M1 stuff, more of the longer term, one of the members mentioned the other day about PG, and they liked PG long term. And I messaged them like, hey, I want you to send a 1-page write-up of why you like PG long term. And if you do write that up and you explain, I like PG for X, Y, and Z reasons, and you've spent the 20 minutes to a half hour explaining why you actually like it, then when things get shitty and you're down 30 or 40 or 50 or 70% of the name, maybe not really in PG, but in Zoom, that's a very obvious reality. Then we look back and say, like, what has changed from what you wrote about 6 months ago to now? And they should have that conviction to stick with it. So for Jay, again, if you really like Zoom video, I would spend the time to write up a 1 or 2 page summary of why you like it. And if you do that, then go for it. And if you do write that up and say, you know what, maybe I was only looking at it chart wise and I wanted to kind of squeeze in that 600% return from this price, then maybe it's a pass. And maybe that money is probably just better suited in the big picture or an S&P or index equivalent. So I think with any long-term name, the short of it is spend the hour or two summarizing, writing down pen and paper or on an email or whatever it is, exactly why you like this company long-term. And if you do that work, you still have the same conviction, go for it. If you don't have that conviction after doing it, you'll save yourself a ton of time, because when these names get beat up, like even for me, names like Etsy and Shopify and Amazon, like I'll be sitting in this name for a while before it's back above my 120, 140 cost basis. But I'm okay with that, and I will wait until it's back up into 300 to take profits. But that's because I have conviction with the name. We sell things on Etsy, so I have that conviction where if he has a conviction in Zoom, more power to him. So hopefully that answered Mr. Ferrari's question.
Yeah, I think also just to always, like, when it comes to these long-term trades, and like definitely taking into consideration what happened with the whole pandemic and like those stocks that did go up, is like, is that true strength, or is that just because of kind of the black swan event that we had? The stock went a lot higher than it would have any normal year of, you know, a market cycle, which I think for this one could be the case. I think that obviously COVID helped boost this one a lot, and it was kind of the perfect storm of, you know, people at home, obviously people using this, more people trading, more retail buyers following the news, and that kind of just pushes all those kinds of things higher. Again, doesn't mean it can't work. It's definitely it's a growing company. I don't know if it can have another run like that, like it had.
Yeah, that's just again looking at, and sorry to cut you off, Heaven. That's just like looking at these names when it's these percentage, again, even Peloton, never once trade Peloton. Like for me, I'm like, you're not getting me to buy a $2,000 exercise bike. You're not getting me to pay that subscription. And to me, it was just a hyped up name during the pandemic that it will never, even like a you know, Peloton was like a GoPro, and obviously, you know, much different, but same thing. It has that 1,000% run up or 400 or 500% run up, and then it starts to hit lows. And anytime in here, it looks like the best deal in the world. Oh my God, I could buy it at 10 and sell it at 100, make 1,000%. And it's been half a decade and it's never saw a price of 20. And I think that's going to be the same for this Peloton. I think it's honestly going to be kind of the same for Zoom. It was a hyped up product, and there's no, you know, again, for Zoom, it's different because again, you know, you might use them in schools, but you know, a lot of the schools are kind of back to, you know, full time. There's no really more of that hybrid in and out kind of stuff. And again, for like, even for us as a business, we could pay for Zoom, but we don't need to be on a Zoom call for more than 40 minutes anyways. And if we do, we just hop back on another one. So like, I'm never going to pay for Zoom. So for me, I'm never going to, I personally wouldn't, but it's just the other assignment I would say for Jay, or for anyone for that matter, is for long-term stuff, again, write up that summary if you really like the stock long-term. And if you can't spend the time to do that, it's definitely not worth a long-term investment. And then two, more specifically with these more bubbly type stocks, is look at other bubbly names. You know, this, when I'm talking about bubbly, it's a stock that's gone up 5 to 1,000% within a year and has retraced a significant portion of that move. So Zoom has retraced basically the entire move. Peloton retraced more than the entire move. Look at those charts, go back a couple of years, you know, for the GoPro examples. I tried pulling up Drives, but I guess they went bankrupt or the stock's no longer trading. But go look back a couple of years of what was popular back then and see how those stocks have performed. And even you go back to the financial crisis, you find some of those similar stocks, some of the 3D printing stocks like Triple D. You know, this stock, perfect example, this financial crisis, you know, Triple D, 3D printing, Elon Musk had Solar City at the time. These were the bubbly stocks back then. And still to this day, this is a decade later, nowhere close to those prior highs. But all this whole way down, oh my God, I could buy it at 10 and sell it at 100, make 1,000%. And never do you make that, but you sit with it for half a decade, you get out of it, and then it does get this little pop, but you're not involved in this move anyways. You're out some point in here. So when when you see those 1,000% moves and they fully retrace, if you can find one example of a stock that's gone 1,000% a year, has fully retraced that move and has gone back to that high, I would love to see it, because I personally can't think of any name like that percentage wise that has been able to turn it back around that second time.
Yeah, I'm with you. Okay, Kusha, I know you had a question you wanted to ask, probably about some charts or something. If you want to go ahead, unmute yourself.
Yeah, so this first question is, where do you see leadership next? I see it in biotech and healthcare. And do you think the move in oil is done?
So energy, I definitely think the easy trade for sure is done for now. I think the energy had a phenomenal run. Again, this is again the monthly chart. You know, third time into major resistance, like couldn't have been more textbook how just purely the chart of the intersecting has traded. And again, very easy move. Like this is now kind of the tough trade. So I do think energy is no longer going to be the leader going forward. Who's going to take over? That is a good question that I don't know. But again, biotechs are definitely starting to base out more than they were in the past. So from like a percentage standpoint, like the risk reward down here, you know, buying in the low hundreds and then looking to sell in the 180s, you know, definitely bang for your buck. If you're buying in the hundreds to sell in 80, you're making 70, 80%, where an energy, that 100% move is kind of gone now, and now it's kind of giving back those profits. And then healthcare again, kind of just, kind of in the middle of its range. I think biotech's just risk reward wise, like a year out. If I had $1,000 to invest and it was energy, healthcare, or biotechs, I would probably go biotechs with that $1,000 versus 100, me risking whatever that is, 20% and looking to make 80%, where I don't think you're going to make that in energy. And I don't think you're going to make that in healthcare. But that's just broadly sector wise. Obviously individual stocks, if you find like a Humana, things like that, it's going to be, stock specific is going to be different. But I think I'm definitely with you with energy leading first place, and then that being subbed in with whoever the next sector is going to be that wants to kind of take the lead.
Got it. And is it okay if I ask a question about the Roth IRA?
No, absolutely not. You can't.
Go for it.
Yeah, of course.
All right. So on the bigger picture, you're talking about that one person that put $12,000. So that means for your Roth IRA, you're allowed to put more money, but you just get penalized.
You're talking about the guy, the guy who did the tax return with someone else, and the accountant messed with their tax return.
Yes. Yeah.
So that again, you don't want to do that. You don't want to cheat the tax system. If it's 6,000, put the 6,000 in, and that's it. And then anything extra, put into your taxable, or until you're self-employed, you can open up a SEP, or until you work at a company that offers 401k plan. It's always way easier to follow the tax guidelines than trying to skirt around it. Again, for him, he didn't put 12,000, he put 6,000 in. The accountant was just a moron and put that he contributed twice. And then when we confronted him about it, he just made up the most ridiculous lie. We're just that's just straight up wrong. But that's what happens when you pay $65 for a tax return. You get, a McDonald's, kind of drive-through guy doing your tax return when, that's what that's what you pay for. So put the 6,000 in. Do not try to over contribute. It's just not going to be worth it. Eventually they'll catch you and they're going to want you to pull it out anyways, and it's just more of a pain in the ass. So just again, contribute to the limit. Don't try to, beat the Uncle Sam, because that's not about it. You're going to win.
Got it. And I have this one chart I'm looking at right now that looks really good on the bigger picture. This VRTX, this 293. I would like to see some more right side basing, but it looks like it's making higher lows every time. The first correction was 21%, next one 13. Right now, it pulled in 6%. We could get some tightening, then look good.
This is one where it's I would just wait for this 300 level. Again, I definitely see what you're looking at here, but I'd rather just buy the blue skies than this. Is again like Humana. This Humana has been setting up for so long now, and anytime that you try to sneak in, you try to sneak in this third time, you try to sneak in this fourth time, try to sneak in this, all these times you keep trying to sneak in, and it's just, you're not getting rewarded for it. And if you do that enough, then when it does start to go, which is right now, and again, it's not going right now, but it's actually putting in new highs, you're not going to want to buy it this time, because you're I got burned 4 times, screw this thing, I'm done with it. Where this is probably the time that, okay, for now, it's just buying through 480, but I'd rather just be involved there than getting in a little bit too soon and then wearing yourself out and then missing it, because when this is going to break out, this has been sitting up for 2 years. So if you think about the longer the stock consolidates, you have to expect a similar breakout. That's why when we find these 1 or 2 or 3 week flags, we should expect a 1 or 2 week breakout. We shouldn't expect a 6-month breakout. So even so for anything like this, we've been saying for 2 years, when it does start to break, there's probably going to be 6 months to 8 months where it will break out. Not going to be in a straight line up. It can still obviously put in these higher lows, but it'd be much easier to just wait and get involved in this area when it's going to actually break. And even this time, it might get up to here still, and that would technically be more just a broad retest. This is that first high. We'll see it retest here. It's still got to pull in. Maybe it's got to still pull into 250, and then it gets back up there. Call it end of year, and maybe that's when it's really ready. But instead of messing around with it for the next 6 months, you just wait for that 300 breakout, and you just get involved then, and then you ride it to, basically 500 would be kind of like that measured move.
I see. And we're seeing some new leadership in some names. And one of the names I'm looking at right now is this HRMY. This could be a potential leader up through 53. It's not ready now, but big base. It could go in time.
Yeah, I mean, no, this is like again, we talk a lot about pharmaceutical names, a lot about biotech names, all names you're looking at. So you're definitely looking at the right names. This is honestly, this is like we just about VRTX. This is like VRTX right now. Like VRTX is like right here. It hasn't really retested that prior high just yet. Like it's like VRTX is like this chart-wise equivalent, like kind of right here. And now, and it looked so good right here. Could have looked better. And it just wasn't, had to obviously just, crush people. But now it's right back again, and it looks even better again. But so now eventually, again, here you're buying 53, buying 54 versus 48. Recent, more of a recent IPO through those IPO highs. Like this looks, this looks really good. This probably goes much sooner than that VRTX, and you probably have a lot more going for you with this. That this, through this level, it's probably an $80 stock once it finally pushes through these highs. Let's see what's this kind of measure move here.
$30.
Yeah, so into the 70s, that would be like kind of that target. Like buying 53 versus 47, you're risking $5-6, and the goal is to kind of make at least kind of 20. And that's very realistic, especially with this setup. Sector strong. Recent IPO is not going to be as market correlated. This, you have a lot more going for you in the shorter term than I think that the RTX right now.
And another thing I like about this chart is leaders bottom first. I learned that from Mark Minervini's book. And this, every time this name places a bottom, it's before it placed the bottom before the market, and every time the market makes a new low, this is making a higher low. So this is definitely on my radar. It's one of my favorite charts at the moment.
It looks honestly very good. Earnings aren't until August, so even if it goes sooner, you got plenty of time. And if it doesn't go until then, probably even better. And if say it still trades within like this range, hold on. Like this is probably the real range of this name right now. Like this is like a little Mickey. This is like a stock for us where like we just want to keep the risk tight. But the real range right now is really this $40 to $50 area. Where say it doesn't go yet, it pulls into 40. It has earnings in August. It gets a little gap up, and then we get that opening range breakout type of trade. That might be what's needed to really push the stock through that high, and then that's when we can kind of be involved. So, but definitely with him, this looks really good.
Got it. That's all I had.
Yeah, cool.
Cool. Thanks, Trisha. So we got one last thing that I want to go over, and it's the CYTK. I want to pull up the chart, Ben. So I had a member reach out to me the other day because they weren't really sure how they should have, or how the way that they executed on the trade, they weren't really sure if it was the proper way to do it. So he wanted to get my advice, and then I figured I'd get your advice as well, Ben. So we were actually buying this one late June. It was like June 22nd, basically like through 44. Through I think through 42 and through 44. It's kind of the area that we were buying with a stop under 38. It was on the shakedown, a little bit of a wide stop and relative to the price, but we were buying. Pretty nice chart, top right, consolidation over the last several months. He got a solid breakout, didn't really take any profits in the 48, and then June 30th, that big gap down that we had, I think it had news on the secondary offering.
Mm-hmm.
Okay. Basically, he used the 15-minute rule, and that if you look at a 15-minute chart, you'll see that first 15 minutes, it went straight back up, So I guess his idea was this is going right back up, and I can just hang on to it, and it'll be fine. And then obviously you go basically the rest of the day, it ends up closing below that 15-minute low, basically getting stopped out at the end of the day. What do you think would have been the best thing to do here? I mean, is that just, do you have to take that loss, or can you kind of avoid it? Like, what do you think?
So 15-minute rule wise, we know what the 15-minute rule is very simply is it's for stocks that you have an initial stop in and the stock is gapping below that out. So for example, again, we know you guys were buying 44 and 42. That's where you're in. And let's just say in this example, your stop was this 45, right? That was your stop. The day prior, the secondary offering comes out. Again, secondary offerings, this company's issuing more stock, and smart companies issue them when the stock is near highs because they're getting the best bang for their buck. When stocks have secondary offerings near 52-week lows, it's the absolute worst sign because they're extremely desperate, and it couldn't be a bigger red flag that they're kind of heading towards bankruptcy. So if the stock comes out of the secondary offering when it's near highs, it sucks for the trader. It's good for the company. When a secondary offering comes out near 50-week lows, it's horrible for the company and it's horrible for the investor. And if that does happen, so do the world, we'll try to get out as quickly as possible when the stock's near lows, which for us, we're never really buying stocks in 50-week lows. So it's not really a relevant lesson, but it's just good to know. So with this though, you have to realize that one, you're in a trade that you had tighter risk in, and now the risk to the downside is much more increased because the stock is gapping down below your out. And that stop is going to basically immediately market you out. So the first thing you want to do is you want to cancel that stop, but you want to remember that you're screwed in the trade. So it's trying to get out for as minimal damage as humanly possible, not really looking to turn this now bigger loser into a winner. That sometimes can happen. And there's one example that I can think of many years ago. I cannot remember the name, but the stock in a secondary offering, it gapped down 15%. And by the end of the day, it filled the whole gap completely. I can't remember the stock though, but that's like the one time that occurred. The other times it's the stock gaps down. You can't stop before the opens. You don't get randomly marketed out. You let that first 15-minute candle set. And for this stock, if your stop was 45, now your stop's 39.89. But then you have to find the exit as quickly as possible. So if your stop was 45 and now your stop is 39.89, and in 15 minutes the stock goes back to 45, you kind of have to get out. Because now and in this example, you would have still made money if you were buying 40 and 44. You're still making some money in it, where the other person who doesn't know the 15-minute rule, they're getting pushed off the open. They lost 5 or 10%, and they're pissed where you made some money. So it's hard for me to say you got to sell at 45 because that's just being perfect. If I was in it realistically, I probably would have been out somewhere in this 43 area where it'd have been okay, fully bounced back up. Again, I'm not that active day to day, so I'm not going to be looking at the 15-minute chart. I would have put that 15-minute rule stop in. And then if I saw that bounce, trying to get out at some point. And I think that's more of the realistic out, out. It's okay. It rips up. If you can take off into strength, phenomenal. I know for me, I'd probably just kind of watch this kind of flag out. I'd probably just get pushed out through here. But this is not one where you're trying to continue this swing trade for days. It's you kind of got trapped. And it's how can you repeatedly get out of these issues that are outside of your control. No one knows about a secondary until it gets announced. If you knew about it beforehand, and basically the insider trading, which no one really has that insight anyways, and it's just managing that loss as best as you can. So,
I mean, especially on a massive gap down like it had, because that's a 20% gap down from the previous day.
Mm-hmm.
So that's really big. If it's 2-3% lower and it's really close to your stop and all that kind of stuff, then you can kind of look to stay in the trade. But when you have a massive gap down and then a really strong buy off the open, the 15-minute rule is kind of your saving grace of just trying to get out without losing an arm. Because once you're down 20%, you should never be down 20% in a trade at all. So if that 15-minute rule hits you and now your stop is 20% down from the previous day, ideally, at least when you see that gap fill, you want to at least take some off. You want to take a little bit off at that point, just so you can reduce that risk, because now your real stop is, like you said, at 38 or at 40, whatever it is. So you need to be cutting at least at third or even half of your position, if not really all of it, because secondary offerings, like you said, most of the time they don't end really well. And as you can see now, it's kind of super volatile over the last 3 days, and it's just more of a headache on your end because the next day it shakes out that low, and now today it's up 6%, and you just have a crazy headache. So I told them, gap down like this, definitely look to trim some off the open if you have a big push, and then just tighten up if you're gonna look at it intraday, just kind of tighten up that stop and don't hold it to that 15-minute low if you get a massive lead.
You gotta remember that with secondaries, find the exit as safely as possible. And unfortunately, the crowd of newer traders continues to get kind of dumber and dumber as time goes on, because now we have dumber and dumber investments that are discussed. But we saw that with Playboy, where Playboy had 2 back-to-back secondary offerings. And that was just,
Oh yeah.
and it was like it gapped up both times. And I'm like, this is just so dumb. Like the stock, and obviously now, perfect example.
Yeah.
They did it at the best time. So when Playboy did this, they had their secondary right here. Stock was as close, obviously that was, and again, these like these bubbly stocks, 600%, down 99% off highs, or down 90%. Things dead. But for them, they did a secondary offering here at 40, and then idiots were buying it up, or dumb money was buying it up, and they're like, fuck it, let's do another one. We didn't gap down, let's do another one. So they sold a ton of stock. Say for example, you need to raise $1,000, and this is your company, and you go, hey Kusha, I'm going to sell you my shares, which cost me nothing. And you give me $1,000, I'm going to take $1,000 and go play with it, and then you can have my shares. It's a great trade for the business, for Playboy, because they got your $1,000. You got some shares that are now worth 90% less, and they have the $1,000 what they want with it. That's what a smart company does. They do that up here. We saw that with Tesla. Last time Tesla did a secondary offering, which is right here. Again, mark the top. Smart companies. They did a secondary offering right here, and dumb money bought it up. It was like, I couldn't believe it that day that Tesla was up 5% on a day that Tesla is issuing more shares to the public, and they're buying it up. It's the foolish crowd, and it's not really. Oh no, this is a split. I'm sorry, I forgot when the hell they did the secondary, but when they did do it, the stock did gap up on it. And again, it's people that don't know what a secondary is, and they think it's good news, and it's good for the company. It's not good for the investor, especially in the short term. So secondaries come out, stock's gonna gap down, give it the 15-minute rule. If it's a bigger gap down, 10, 15, 20%, you got to find that exit that same day. If it's a smaller one, like Kevin was saying, a couple percent, then it's a little case by case. But if you're down 20% at 9:30 and then you're up 5% at 9:45, you got to take that money and run, because it's not going to turn into a 100% trade. It's going to get faded when the smarter peasants catch wind of this. They're not, the smart money is not buying the name when it's up 20% after secondary. So hopefully,
and then I mean the other thing I believe that I think he could have done better too is if you look at the trade and you look at where he was buying the breakout on CYTK. I mean, he was up 10% in the name at some point. And I asked him, how much profit did you take on the way up? And he said none. And obviously hindsight's 2020, but a stock goes up like that, you're up 10%, it's up 3-4 days. It's like you can tell that it's sort of starting to lose steam there. That's a profit taking area. And like Kusha mentioned in the chat here, is if you zoom out to a weekly chart, that's a retest of all-time highs.
Yeah.
There's multiple reasons here of why you need to be taking profits. One, just the market environment in general. We're not in that strong bull market where you buy a top right chart and it's just going to go for 3 months. We're in a much choppier environment. It's important to take money a lot quicker. Sometimes that's 1-to-1. Even you don't really want to wait out for a 5-to-1 risk reward on a swing trade, because most of the time these stocks are not going 5 times further than the proper risk in just a couple days or at all. So, it's really important to take profits pretty quickly. So I think that's one thing that he really learned is like, even at 1-to-1, it's a good time to take some profits, reduce that risk, and don't go too big in these trades either. I know he mentioned that he had 18% of his account in this trade. I was like, why? He's like, I don't know, I just like the trade. I'm like, well, that's great. But, in this market and nonstop, we've just been repeating it. It's like, you have to kind of tread lightly in this environment. Even if the setup is A+, you shouldn't be going as big as you were going, last year or the year before that.
There's two quick things I want to mention. One is, again, I mentioned the big position. Even if you're selling one share, we're very good, all of us, very good at buying a stock, very easy to buy stock, much harder to sell stock. Most of us, myself included, very bad at selling stock, because when they're up, we think they're going to go higher. But the more you get into that process, and even if it's one share, I'm up 3%, I'm taking one share. I'm up 4%, I'm taking one share. I'm up 5, 6, 7, 8, 9, 10. One share is so insignificant that, especially if it's 18% of his portfolio, it's not going to make a difference. But you will start getting in that habit of actually selling and being okay with giving away stock. And then you will start to learn that within your range, like I know for me, I'm usually risking 1%. I'm trying to risk as close to 1 to 0% as humanly possible. And I know 4 or 5%, that's my 5-to-1. I need to get better at when I'm at 3, 4, 5%, taking some off to build up that muscle of selling some stock.
Mm-hmm.
And for a while, you look, okay, well, my average trades, I'm getting up to 8%, and it's coming back. And as you learn that, then you can get rid of that 2% sell and hold out for the 3% one. It's a little bit more there. And you find your kind of percentage range of losers to winners. And again, and the other thing with this, again, the retest, it always looks beautiful here and it gets smoked. Same with like the VRTX example with Kusha. The one thing that I've been trying to do lately is I add these alerts and I make them basically like making fun of myself, so like take profits, you idiot. I don't know if you can see this on my screen, but if that's the retest, when it gets there, we're gonna think it looks amazing, but that alert's gonna pop up, it's gonna take profits, you idiot. Maybe I should take some off, because as beautiful as the thing looks, it is a retest. We've seen it 1,000 times, but when we're in it, we think this one's gonna be different. So those are just some things, even like you saw in Tesla. There's a member that I was working with on a trade review, and they're up like 400% in Tesla. Never sold anything. $5,000 position, it's worth $30,000 right now. And Tesla will probably bounce up into 1,000 at some point. And if you haven't, she hasn't sold any yet, this is the time to start taking some off. Not all of it, but you bought the thing at $50 a share, it's at 1,000. Let's take some money off the table. Let's make the gain real, and not let's let this become the next Peloton. Because again, Tesla is, the Trojan horse right now, but this pattern eventually resolves. And just like Tesla, it can continue looking as amazing as it wants to, but eventually when it breaks this 600 and 500, it will be just as quickly back at 4, 3, and 2, and no one's going to be on the wiser. But that's when you want to be taking anything off any of these pops and realizing that gain, making that and turning that investment into real money that you can put somewhere else. So that's kind of my last two little points on that 15-minute rule topic that we kind of went off topic a bit with.
Yeah. Well, I mean, that's all I got here. I think there's a lot of good learning points there, especially at CYTK. Shout out to that alpha member that hit me up, because that's a good learning lesson for anybody. That 15-minute rule it's there to save you. It's not there to, so much take advantage. I think obviously on like a smaller gap down, and then it really pushes up above the previous day's high, things like that, where it's almost like a shakeout versus anything else. That's where maybe you're not taking off risk or as much risk, but on a massive gap down like that CYTK, you get that, you get saved in the morning. You want to take some off. You don't want to push your luck. So that's all I got, Ben.
Right. Kusha, how's your nose doing? And then you got Django in the basketball game, looking a little crazy over there.
You're working on it.
Yeah, you'll be a model by next week.
When's the nose to come off?
I don't even know. I'm gonna be honest. Here's the crazy thing. When I was out of country, I tried logging into Schwab. It goes by face scan, okay? And I don't know my password. So I can't log in, so I couldn't trade for a good bit until.
Oh, yeah.
That's too funny, man. Well, hopefully it recognizes you when you take the Band-Aid off.
For sure.
All right, Kusha, well, glad you joined us again on this call, and we will see you guys next week.
Yep. Catch you later.